Welcome to Equipment Finance Advisor's video series. I'm Michael Toglia, the publisher of Equipment Finance Advisor, and today I have two guests with me. My first guest is Kayla Perlinger. Kayla is the Vice President of Syndications with Oakmont Capital Services. And I also have with me Tim Appleget. Tim is the Director of SaaS Products with Tamarack.AI. Tim and Kayla, very nice to see you today. Thanks for joining me.
Yeah, thank you for having
Great
us.
to be here.
Good to be with both of you. Yeah.
Thank you. Well, today we're going to talk a little bit about what's happening in the syndications market. We're going to look at it from the perspective of Kayla's perspective as somebody who's actually in the syndications market every single day. And then Tim, we're going to get your perspectives a little bit of how the technology is impacting that market. And Kayla also has a strong background in technology. We'll tap into both. So if it's okay with you, I'm going to start right in with the first question. And I think one of the best places to start is just real quickly, actually, to ask you to tell us a little bit about your roles within your respective companies. Kayla, I'll start with you.
Yeah, absolutely. So I'm the Vice President of Syndications here at Oakmont Capital and primarily involved with the sell desk side of it. So I'm selling portfolios typically monthly. We have a lot of current partners, existing partners that we have transactions with on a monthly basis, some happening quarterly, but again, primarily on the sell side, not buying portfolios yet. That may happen in the future, but I've had experience purchasing portfolios in my past life actually, and now primarily selling and working the sell desk. So.
Okay, great. Tim, how about yourself? Tell me a little bit about your role over at Tamarack.
Yeah, I have a business and IT combo background, kind of a hybrid type of person for this industry. I've done both, more recently IT leadership type roles at Tamarack. I'm really as the director of SaaS product, I have full responsibility for developing out the product, making it compatible with the needs of the marketplace, and in building out futuristic oriented things around our AI products. So client engagement is also certainly a big part of my role. So need to stay close to the marketplace and appreciate these kinds of conversations. So, yeah.
Okay. Well, thank you both for that. I think that's important to establish where we're all from. The first question I have today is, I'm going to start with Kayla, and that is, it's a very 40,000 foot level type question. And that is, why is syndication so important today in the equipment finance industry from your perspective?
Yeah, absolutely. And I know that question can can have a different answer depending on the type of company you are, the size of entity, how you operate. But I think one driver that kind of stays true is really improving liquidity, right? So whether there's some companies that operate on a warehouse line, for example, there's other companies that do business differently. But I think a main driver is typically improving liquidity. So at Oakmont, for example, when I onboarded with Oakmont, I was selling portfolios and we had a warehouse line. And depending on your terms, you may need to syndicate those assets off of there. Maybe you have 3 months, maybe you have 6 months, whatever your terms are. However, as you grow, you of course need to build out those warehouse lines, sell off those assets. And even beyond just having warehouse lines, there will be other reasons that you still need to kind of really improve that liquidity. So you never want your existing balance sheet to kind of hold you back from originating new business, right? Where you may even have assets on your books that have a strong rate. However, if that's preventing you from being able to get new business and to establish a new customer base, that's still not a great spot to be in either. So liquidity, capital reasons are always kind of a main driver. Other drivers out there, depending on the company, it could be diversifying assets and industries. Maybe you want to hop out a little bit within your portfolio, just kind of managing your own portfolio. And on the buy side, of course, it's a great way to really diversify. So maybe you're a transportation company where you have a transportation portfolio right now, but you really want to get your delinquencies down. Well, maybe you want to hop in and purchase a portfolio with different types of assets. That's certainly a much faster way to do it than working on originating those assets, right? So it could be rebalancing your portfolios. Maybe there's some low rates in there, those deals that you really want to sell off. It could be regulatory compliance reasons, risk management. There's a lot of different reasons out there that we can kind of get into, but those are really the main ones that I hear today.
Well, and that's a lot, because when you get into the whole liquidity discussion, it is a lot. You're talking about risk management, as you just mentioned, portfolio management. We're getting into a little bit of everything. Also, they're opening the door to do continual business with existing clients or other clients as well. So there's a lot to the picture here. Tim, I'm just curious from your perspective. I know Kayla covered a lot there, and there may not be too much to add there, but is that consistent with what you hear from most of the clients that you're dealing with out there?
It is. She touched the spectrum that I was thinking of and beyond. But I certainly, from a provider perspective on the IT side, data services, what we're hearing from folks is like the capital restraints around some of the banks being a little more restrained around their willingness to lend. We're also seeing some a little bit because the economic environment has been more mixed the last few years. It feels like people are doing a little bit more proactive management of their portfolios, wanting to pull out spots where they feel like there's weak segments in the mix, those types of things. So those are probably the main things. And then I think because of the capital restraint and businesses want to grow, they need to find new sources of capital to create liquidity, like Kayla was referring to. So that's kind of what I've been hearing, what I'm seeing. So yeah.
Okay, great. Well, thank you. Kayla, something that just came to mind when you were saying that is that, okay, you're on the sell side, which means you're looking for sources to buy. Have the sources to buy grown because of the private credit players out there, for example, that might be interested in taking on some of this debt now? Because it was a long time ago, we didn't have as many players. Has that opened the door for new avenues for Oakmont?
Yeah, in some ways, yes, and in some ways, no. So, in the past, especially in the past few years, there have been some partners that have hopped in, but there have been other partners that have hopped out for varying reasons, right? Where I know back in particularly, I think it was, around the time of COVID, we had a lot of bank partners that wanted to hop in and really get our assets. And then, of course, as rates increase, they kind of hopped out of there. So we do see that, but it kind of depends on so many different variables as far as who's going to hop in and who's going to hop out. So really, to that point, though, it's really we have really strong buyers. We have a good variety of buyers, and for that very reason, right? Where there are some partners that I think we all know that are really committed to this industry, but then there are always those partners or those banks that hop in and out for various reasons. There may be some independents that purchase the portfolio here and there. So I think it's really important to have a good variety of strong partners when you're really buying or selling portfolios.
I understand. Absolutely. So what's changed? What comes to mind is what's changed about syndications over the past 5 years. We're post-COVID, of course, but what's changed over the past 5 years, and what are maybe the low-hanging fruit pieces that you see have changed the most over this past 5 years? I'll start with you again, Kayla, if that's okay.
Yeah. Yeah, when I think about the past 5 years, I mean, you mentioned COVID and just it's been a whirlwind, right? Where usually when you think about the past 5 years, there's always things that have happened, but specifically this time period, I mean, when you think about the pandemic, you think about partners hopping kind of in and out of syndications. You think about the rates, the lowest of the lows and not the highest of the highs. It was just more of a dramatic shift to a higher rate. When I think about, selling portfolios in the threes, I mean, what a crazy thing to think about, but that was not uncommon. And then I think the biggest piece was how kind of how fast it changed where you're selling a portfolio with a discount rate in the threes and then the next year it could have been in the fives and then the sixes and then the sevens. So I think the crazy thing about that was still having those assets on your books with that low of a rate, and then if you were in a scenario that you needed to sell those assets, that's a hard that was a hard time to be in, right? Where you could have deals at 3%, but then the discount rate might be 6%. And a lot of people were in that scenario. If you needed to syndicate and you didn't syndicate that fast enough, that was tricky. We had, there's, some partners, as we know, that hopped out of the industry. There are some that hopped in. So I think it's just been, an interesting time. But I think we're also, now reaching the time where, yeah, rates did rise. And I think it was a shock to the customers more so than I think to even people in our industry. But I think the customers even started to understand, okay, this is just more normal than, they were just used to a low rate, right? Where then when they heard 6 to 7, that was very high. But I think customers have now come to the realization, well, that's not really that high. It's just getting back to normal. So we're kind of anticipating, rates to hopefully decrease a little bit. But it's been a whirlwind, but it's been really exciting. And kind of going back to the relationship side of it, that's why we have those good partners for these cyclical times.
It makes sense, and you have to retain those relationships.
Mm-hmm.
Tim, from your perspective, I mean, what do you think has changed? You talk to a lot of people. I mean, Kayla being one of them, but
Yeah.
you talk to a lot of people. What's changing out there?
Well, I guess from a tooling perspective, in terms of managing the process, it seems like it's gotten far more dynamic, as Kayla described. You got to be fairly agile. Traditionally, I come from a large bank that did a lot of buy type work, and the pretty low investment from the software companies and participants in the industry around the tooling that supports this process. It's very data intense to create these pools, and it's done often through primitive sort of spreadsheet oriented support. And so I'm seeing, we're starting to see some emerging support coming from this industry around some investment in tooling, some additional tooling that's available that make this process a little bit more efficient, more friendly, allow someone like Kayla in her role to focus more on the important parts of the deal, which are the economics of the transaction. So that's kind of what I'm seeing.
Okay.
Yeah.
Well, let's talk about the data side about it a little more if we can. And that is, you know, how has the consolidation of and access to data really impacted the syndications, the capital market side of the business? What's happening there? I mean, there's a lot of different demands right now. On this one, I'm going to start with you, Tim. You mentioned that there's a need for, but how is that impacting it? But what's everybody looking for? Is it really portfolio analysis? What are we looking at here mostly when we're looking at the data side?
Well, I think, at least from what I'm seeing, everybody has their partners. Those partners have very distinct credit profiles, credit boxes they're trying to hit with the pools. That means if I'm going to do pools of 50, 100, 500, that's a lot of data to collect, a lot of profiling that needs to be done to all, we're seeing situations where, customers have certain partners that have, there may be 15, 20, 25 attributes that need to create the profile for that particular buyer in terms of fulfilling their interests and their desires for what they want in the content. And so pulling all that data together from a front end, a back end system, if there's ancillary systems where the data needs to be pulled in, it's very difficult. It's very cumbersome, very labor intensive to do that on a spreadsheet basis. All those deals, of course, are getting transactional activity every day. So there's payments being posted, there's dispositions occurring, there's other forms of maintenance that are going on with those contracts. So just to have some sophistication around the tooling is becoming more and more of a challenge and a bigger deal, and it's inviting companies like ours and others that to come forward with some advanced tooling. That seems to be what we're hearing from the marketplace. We were in this business originally thinking more of a broad-based data, business analytics focus, AI focus, and we kept hearing emerging desires and conversations coming from folks that we want to see if you guys can participate in giving us some more efficient ways of working through this process. So.
Okay, great. Thank you, Tim. I appreciate that. How about you, Kayla? I mean, you're very heavily involved with the technology side as well with OCS. I mean, you're not only running the capital market side of that. How is it impacting what you're doing internally in your company?
Yeah, I think Tim was really spot on, and I can see this whole process really changing and evolving in the next, hopefully the next few years, specifically the next 5 years. But really, Tim kind of nailed it where it was, in syndications, we've always had a lot of data points that we have to track, we have to provide with a high level of accuracy. But with it seems like there's more data, right? I mean, there is more data. So even when you think about credit scores, you think about commercial credit scores, it's not just the score that we're tracking these days. It is, we've always, when you think about underwriting a transaction, you're always underwriting beyond the score, right? But in these times, we're trying to track all of those attributes into the system. So how do you control those? How do you use those in a way that kind of helps syndicate those transactions? And we've even found actually different types of attributes that are being requested from our partners. So I think it's going to be continuing to use the data, compile the data in a more efficient way, more effectively. That's a huge driver. So when you're compiling a sale, I mean, ideally, it should really be fairly streamlined and fairly automated where you have all of those data points into your system. You know what the partner wants, and you're really efficiently compiling that. And then, that data tape has been a monster in our industry for a very long time. It still is. I don't have one partner that doesn't want a data tape, right? Where maybe in the future we are on a portal, we're on a system where they're underwriting in a different way, but right now they want that spreadsheet and that data tape for different reasons in an Excel file. And that's a huge uplift for some teams. You may be getting front end data from one system, back end data for another. So how do you compile that in the most efficient way? And that's something we're working on with Tamarack actually right now is efficiently not only compiling those sales, but efficiently getting that data tape. And then beyond that, we would love to even analyze what our partners have purchased and what will they purchase in the future, to use the data points to maybe have those conversations of, for example, use AI, right? Where use AI to kind of analyze what they're purchasing, even at a deeper level. When you think about one industry that may be a little bit riskier for them, but it's not cut off. But maybe you find those holes, those pockets that they really want, and you're able to really kind of streamline that portfolio process. So, and again, just using AI as we're working with Tamarack on that front to really have those conversations, to maybe allow those partners to open their mind to purchasing more deals beyond. I always say just beyond the scores, right? Because there's so many more attributes out there that we really need to analyze to really get to the true risk of a deal.
Yeah, it's interesting because you mentioned something that came to mind, and that was the issue of all the data that's required, but predictive analytics here. Being able to somehow predict what's going on, what maybe a buyer might be interested in. Tim, and I'm going to come back to you on this one, Kayla. But Tim, are you seeing that being a part of what's going on with the Tamarack process here, meaning that it is predictive type of data now at this point?
Yeah, we are doing some of that. We have not done it yet in this realm, but we certainly have thoughts about how that can be done. To Kayla's point, more precisely diagnosing really the profile or the personality of the portfolio that is of interest to distinct partners. Certainly AI can mishmash and compile significant amounts of information and arrive at a very distinct and very precise personality, more so than these traditional methods of trying to filter down to a portfolio. So I do see that arriving soon. We've certainly had a fair amount of conversation around that initially here, but yeah, I see that certainly in our future. We've applied AI elsewhere, and that's exactly what it does. It diagnoses personalities. It predicts outcomes that fit a situation, and it's going to be a great fit here. So.
It sounds really, and it's evolving so quickly, and that's the thing that's really interesting here.
Yeah.
My last question is probably going to really be more for Kayla in this situation. That is, we've had a couple of interest rate cuts. There's an anticipation that there's going to be additional interest rate cuts over in 2025. We don't know what that's going to be, obviously, but how is that impacting, or how do you anticipate that impacting the capital markets side of the business, the syndication side?
Mm-hmm. Yeah, it's a really good question. And I feel like I should resign from forecasting some things that happen, because it seems like it's just it's hard to predict sometimes. But what I'm hoping is that the cost of the capital is less, and just like in the past that there will be partners that kind of hop back in and want our assets, which would be really nice. We've had partners that have continued to purchase portfolios, but hopefully there'll be those other bank partners. And we've actually seen it even in the past few months. There have been banks that have actually reached out to us and have been wanting to purchase again, and they haven't purchased for quite some time. So that will be good to see. So it's hard to tell, but I'm hoping that'll cause more activity in the syndication market.
Okay. I've covered the questions I had for you both today, but I always like to end the interviews by asking if I missed anything today, something I should have asked that's pretty obvious, or just you wanted to talk about today. Tim, I can start with you on that. Did I miss anything today? Anything you want to mention today?
No, I don't think so. I think we had pretty good coverage of the topic from my perspective. I do think that, again, I will say that historically, when it came to the IT budget, this particular area, this process was not getting investment, and it hasn't necessarily in the third-party marketplace either. And so, but that's changing. It's definitely changing. So, yeah.
Okay, great. Kayla, did I miss anything from your perspective I should ask today?
No, I think kind of as we discussed in the future, I see that this process is going to change and really evolve. And to Tim's point, it's just been an area of the business that it's not last necessarily, but when you're building out a system or really building out anything, sometimes it is the last thing because it doesn't, anything that doesn't touch the customers sometimes gets, put on hold. But I really see this process evolving because I think it'll really make, a profitable impact to the business by using technology and AI and evolving the syndication side of it. So.
Okay. Well, thank you both for being here today. I appreciate your time as we're coming to one of the busiest times of the year at the end of the year. So I'm gonna let you both get back to work. Thanks again for being here. My best wishes for the good close of the year and a happy holidays as well to you both.
Thank you so
Thanks.
much.